Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 25-30 minutes here on Options Guide TV. Today's date is Monday, June 3rd. The markets are open, and we are looking at two trades today. NVIDIA has made the announcement that very quickly, by the way, of the date when we're going to trade post split 10 for 1. So on June 10th on the open, the stock will be divided by 10 and be trading somewhere around 100 and some odd dollars at that point in time. Nvidia is all over the place since the news has came out. They had a recent conference, and the stock is just really moving in general. They've already announced another new chip that is in the making, and right now the stock is trading at $1,123.73. It's up about 2.5% on the day, or about $27. So when they made the announcement, we were right around $1,000 at that point in time. They did it at their earnings report. So it has had a strong move to the upside so far. June 7th will be the last expiration that it will trade at this higher valuation. The implied volatility on the option contracts is trading right around 52%. So you have a high price stock, you have a fairly decent amount of volatility, considering that there's no major earnings report or anything going into this stock split. And obviously, so far it's been positive for the stock, but you could also say that the news just in general has been positive for NVIDIA, which could also be driving the stock price higher overall. But before I get into that, I'm going to look at a trade in NVIDIA, mainly because it's really our last chance to do so before that split. And if you're trading options in general, I'd rather trade $1,000 stock than a $100 stock, and it just has a lot to do with the premium. And options are priced like insurance products, and a lot of people don't think of options that way. They think of them as a pure speculation tool. But if you're insuring a Bentley, that's going to cost you more than insuring a Ford Taurus, right? It's just a total valuation of the underlying price of the car. So the more expensive the underlying, the more expensive an at the money 1 week option contract's going to be. And that premium in option trading makes adjustments more interesting. You don't have to buy as many contracts, but also you could look at it too as I don't get to buy as many contracts, right? In that if you have a lower price stock, one of the benefits is instead of just buying one option contract, which in NVIDIA is a perfect example right now because it's doing a real straightforward 10 for 1 split. You can buy 10 contracts, right? So instead of just buying one at the money option contract, if you bought it right now on June 10th, you're going to end up with 10 option contracts in your account at a much lower price, at a much lower strike. So the fact that we're doing this 10 for 1 split and we have 1 week where we have these high priced option contracts relative to the stock and also have decent volatility makes it almost imperative that we do one last trade in NVIDIA here on Options Guide TV. But unfortunately, on Friday, we actually went out and looked at a skip strike butterfly in the NASDAQ. So right now, there's not much that I want to do with that trade, but the market almost rallied as soon as we put the trade on. And if I'm going to do a trade going into the weekend, I want to get a little closer to the close before I would put that on. I want to get the decay from the weekend, but I don't really want the movement of the marketplace, if that makes sense. But we always tape the show at 11 o'clock Eastern time, and the market went against us pretty hard, actually. So we're probably going to have to adjust this trade, and we got some time to do so. We did a 1 week trade in the NASDAQ with the June 7th expiration, which means we now have 4 days remaining, and we did a skip strike butterfly, and it has moved against us and it is hurting us. So I'm going to start. Let's move to the TradeHawk software, and look at where the trade is at right now. Okay, so this is as of today. And one second here. There we go. Okay. So as of today, we see the market at 18,522. When we put the trade on, we were at 18,280. So yeah, it was almost like the market knew that we put the trade on and decided to go against us. And this is where the market is at right now. Now, this is as of today. This isn't from Friday. These are using today's markets. And you see that as we move through here, if the market keeps going this way, it could be very painful. So, if you did it today, you would be down about $700. We'd probably be down a little bit more than that. If we go and look at the trade, let's grab it and see if we can. Yeah, that happens a little bit. There we go. And send it to the trade ticket, but it's not letting me click this button. All right, so we'll just go set it up. So if we're in the NASDAQ, and we're looking at our skip strike butterfly that we entered on Friday. We have 4 days remaining. We need to be in the June 7th expiration date. Market was at 18,280. It's now $18,503. And the market has reversed. It was up to start today, and now the market has actually sold off a little bit. So the trade's going to look a little bit better, but it's still kind of painful. We're talking about the strike that we bought is 18,720. So let's get to there. This is the one we bought, and we are in the June 7th expiration, and that is correct. And 18,750. This is going to be the one that we sold. We sold that one twice. And then we go down to 18,7 18,810, and that's the one that we buy. All right. So right now it's showing a net. It was actually lower than that. So now it's at down 715. Oh, we moved back. We just jumped again. We're up $5 all of a sudden. Turn around. We were just flat in the market. Now we're up 5. So we're moving all over the place. And it has probably a lot to do with where Nvidia is. Nvidia is like the third biggest stock in the NASDAQ. And that's might be a big reason. Microsoft is also big. Apple obviously is big, and that's up about 1% on the day. So we're at 665. We put it on for $2.40. The market is about 140 points away from our long strike. And if we jump back to the what if calculator, what will happen is as the days go by, I would like to get one more day of decay. So we're on June 3rd. Market's here. Let's go to Thursday, June 6th. Now the market starts bending a little bit. This is where the market is at. We're much better off. And if we get to Friday at this time at 11 o'clock, now we have a whole lot of time premium, and every hour that goes by, let's go to 14:56. Now we start getting closer and closer to what it looks like on the profit and loss graph, but our maximum risk here is going to be close to 3,000. That's what our requirement is on that trade. It would be 3,000 minus the $240 net credit that we brought into the account. So we're now trading at 670. We're down about $500 on the trade. Market is moving hard this way. If it does end up coming up anywhere close to this strike, if we get to the 18,680 level, thereabouts, I'm going to want to adjust the trade. Either you want to just take the trade off and move on with that, or we're going to actually come out and roll the position up and out in price. So there's a few things that we can look at. We'll probably come back on Wednesday and look at a trade in this, but I might have to adjust it prior to Wednesday. If I have to make the adjustment on Tuesday, I will tweet out the adjustment that is made in the NDX. But I do kind of want to watch where we're at right now. Market is very moving very quickly in the NDX. So let's get on to NVIDIA. NVDA is the symbol. We're trading at $1,126.30, up 2.7% on the day. A lot of that probably had to do with the recent conference and some of the chips that they are talking about and some of the things that they're doing in the space. And also you throw in the fact that they're doing the 10-for-1 stock split. So in this instance, and if you have any comments on where you think NVIDIA is going to go to prior to the split, yeah, let us know in that chat box. If you are in the Tradier YouTube platform, you can actually anything that you put in the chat box, I'm willing to address and actually say out to the crowd. So if you are on the YouTube platform, please let us know. Jump into the chat box and make a comment. Where do you think that NVIDIA is going to go next? Now, in my opinion, there's still a lot of juice, but there's a lot of skew in the put side of things, which makes it really hard to even set up a butterfly or some other type of ratio trade on the downside. Now, on the upside, if I look at a skip strike butterfly, I'm also extremely nervous because who knows when a company announces a 10-for-1 stock split. There's no obviously it does nothing to the valuation of the company. It doesn't make it a better company. It doesn't make it a less better company. Bottom line is most people just like to be able to buy 100 shares of things, and that nice big round number by doing the stock split kind of helps that out. So instead of doing something fancy on the trade, all I really want to do is come in and actually ride the momentum of the trade, do a shorter term trade with only 4 days remaining to the expiration, and we're going to actually just buy an at the money long call spread. I think you flip a coin here on if it's going to go up or down. So I want to set up my situation where I'm going to sell a lot of that time premium on the at the money option contract, go a little bit deeper in the money, buy a more expensive option contract, but I'm going to be selling less time against it. And then we have our adjustment that we've made many times in our SPX trade where if the market does go against us, we can roll it into a butterfly and bring in a net credit to the account. Right now, I kind of like that trade. I'd like to do something with the puts, but the skewing and the volatility just makes it a little tough to get something that interesting off. If we're looking at about a 1 standard deviation move, this is the put side of things. I was thinking about trying to sell some premium, thought about looking at a skip strike butterfly. But if you look at the implied volatility skew, if you're starting at the 1060 mark, right at a 1 standard deviation move, you're talking about a 54% implied volatility. Go all the way down to the 1015 strike, and you're looking at a 59%. So implied volatility is creeping up as we go further out of the money, which you would expect, but it also makes it harder to do some of those trades because of that volatility skew with the butterflies, because you're paying more for that leg of the butterfly that you want that protects your trade. So instead of looking at doing something fancy, we're going to be pretty straightforward with our trade. We'll be willing to make that adjustment, and we'll come back on the show on Wednesday and we'll think about doing the adjustment. But we're going to go fairly wide, so it's going to cost us a little bit of money here. We got the market at, I want to sell the most at the money option contract. So we're looking at 1,125, and we're highlighting that strike. That's the one that we're going to sell. So first of all, let's send that to the what if. I'm going to keep that one in there. Market keeps moving. Now it's saying 1130. 1128, 1130. All right, let's sell this one. So we're going to clear this out, and We'll go 10 points wide. We'll buy the 33.40 three $33.40 option contract, the 115 strike, and we're going to sell the 11.25 strike. So if we do this, we're paying a net debit of $5.52. If this is where the skew is helping us on this end, in that we're already in the money. Now it's looking like 4 points in the money. If the market stays where it's at, this trade will be profitable. And it has a lot to do with the fact that we are buying a lot of intrinsic value. And if you look at the extrinsic value, that means that we are selling $19 or we're buying $19 of extrinsic value. We're then going to sell the 11.25 strike, which is $23 of time value. It still has some intrinsic because we're a little bit in the money and the market's moving fast right now. So we're buying less time premium than we're selling. That means that this is really, well, it's theta positive. You don't mind time decay. So if the market just stays where it's at, obviously you're above the 11.25 mark. So you can make the maximum that you could make on this trade if the market just stayed where it is at. And that would be, let's call it for sake, we'll call it 550, just make the math simple. So you're risking $550 for every 1-by-1 spread that you put on, and you are have the potential to make $4.50, and that's the width of the strikes, 10 points wide, minus the net debit paid for that trade. So even let's just send it to the what if calculator real quick, like, and you'll see that this is where the market is at. We basically are saying that we want to take time value out of this trade. We're going to time decay is actually our friend in this scenario. If the market stays where it's at, eventually this line will start morphing into what it looks like at expiration. As we go up to start with, we still have a huge rate of decay happening here. So we're on June 3rd. So we still need time premium to go away because we sold a lot of time premium. And in order for this to max out, that time value of that option contract that we sold has to wither away. So if we go to Thursday, you'll see the line change, but it's not changing a ton. You really need to get once again to Friday to start being able to make the maximum on the trade, or you need the stock to start running up this way, which is very possible that it could end up getting very deep in the money. And that's one way that we can max out on our trade. Now, if we come back on Wednesday and the market has gone down, what our adjustment would be is to sell the 11.25 and then buy the 11.35. So we just basically be rolling into the butterfly. We start with a long call spread, and then we look at, well, the market's gone down, and let's say it's gone down, we'll say 3% to the downside, and it's gone down about that amount. We'll then say, okay, I'm a little nervous about where the market is at. I was really hoping to get the pop up going into this split. Now that the market is down, I am going to sell the short spread and I'm going to complete the butterfly, taking off some of the risk on the trade. So when would we sell that short spread? Well, in my mind, it's not really about the stock price. It's about the price of the spread. So let's look at that. Okay. So if we come in and look at selling the 11.25, we would be buying the 11.35 here. So right now, that's a $5 net credit to the account. What did we say? We said we were paying $5.50. So that basically means the butterfly right now, if you do just a 10-point wide butterfly, which is, scary in itself because the stock obviously can move so much. But if you were just to do a 10-point wide butterfly, it would be worth 50 cents at this point in time. This is trading for $5. I'm putting it on for $5.50. What I would want to do is if the spread came down and started trading for about $2.50 to $3, somewhere in there, then I would consider putting it on the butterfly, and that would cut my risk in half. So the way that I look at it is if you did the trade and the market went down, you could just sell and get out. But then you're out. You no longer have any chips on the table anymore. You have no way of potentially making the money back. So if I'm going to do that type of strategy and I'm going to do it, that's all right. That's all right. That's how you manage your risk. But I'd much rather start with a trade like this. If it goes against me, cut it in half and hope that, and then you're just really playing the hope game at that point in time that the market actually comes back and lands somewhere within those strikes. And I'm looking mainly, if the market goes against me, to get out at a minimal loss or no loss whatsoever. If I get a gain, that's awesome, but that also means that I'm going to probably have to ride it all the way to that expiration date, which it would be June 7th. So put the trade on right now, pay $5.50 for it. If the market goes down and we see this spread trading somewhere between $2.50 and $3, wherever I want my risk to be at, with me, I would wait until $2.50, but some people might want to sell it if it gets to $3 and take half that risk off the table, then have a new butterfly position on, added no more margin to my account, didn't have to add any more cash to my account. As a matter of fact, I brought in cash when I did that trade. And so we start off with no margin requirement. Our risk is the net debit paid. The market goes down. We take off a little bit of that risk by rolling into the butterfly. And that's going to be our hedge. And that's the way that we're going to approach NVIDIA this last week before they get into their 10-for-1 stock split. All right. That's simple. Any questions, comments, please put them in the chat box. And if not, I will screenshot. Well, actually, here's the screenshot that we'll be taking. We're going to be buying this one and selling that one, the 125. So let's get rid of the 35. And you could roll it into a skip strike if you wanted to, I guess, and go a little bit wider and bring in a little bit bigger of a credit. But the name of the game when I do this adjustment on my long call spreads or long put spreads, even if I'm making this adjustment, the name of the game is I don't want the cheese anymore. Just let me out of the trap. And so I'm doing it hoping that I can actually get out at break even, and it's an alternative. It's a plan. And that's what's really important in options, is that you come up with a plan and then you stick with your plan and you be consistent in the way that you trade your long spreads, long call spreads, long put spreads, however you want to approach it. All right. Well, no comments or questions. Thanks for coming, everyone. Please check me out on Twitter if you'd like to know about any events that we have going forward. You can actually stream Options Guide TV live on x.com. My handle is at Brian Overby, and we'll see you this Wednesday for the next edition of Options Guide TV, 11 a.m. Eastern Time, inside the Tradier Hub. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.